Hi, I just want to share with you some of the key thoughts after meeting several policymakers and CEOs around the world. So the main driver of economy remains electrification and digitalization, with machine learning and artificial intelligence just being the last derivative of the process of digitalization of the economy. From a geographic point of view, the US has decided to run a hot economy. That means higher growth, higher inflation, and with an 8% fiscal deficit and a 3% current account deficit, it's running a twin deficit of more than 10% despite a 4% unemployment. We think this is a risky strategy. Now the US dollar requires 100 billion of funding every quarter. So basically the US government needs $3 billion a day. That's a lot of money that the US economy is basically sucking from the rest of the world. So US remains strong. There is no sign of any slowdown. The Fed decision to cut rates could prove a bit risky, in particular ahead of an election that can be contested, and with both Biden and Trump pro-spending and pro-printing. So at the margin, risk, in my view, vis-a-vis what is priced in fixed income market. Clearly super positive for financials. Secondly, in Europe, not much growth, but no recession either. And at the same time, inflation is coming down very, very fast. The SNB, the Swiss National Bank, with one of the strongest currencies in the world, is cutting rates, and is cutting rates ahead of the ECB. I think the ECB is a bit late. They take decisions based more on politics than on economic and data. Remember when they kept on saying the inflation was temporary, and as a result, I think they're going to cut, probably a bit late, but at least they are on the right path going forward. This again, very positive, because anyway, inflation remains sticky. For sure, rates are not going to go to zero probably ever again in my lifetime, and we're going to keep rates around 2 to 3%. So conducive for super high profitable financial system, where for the last 15, 20 years, they paid the tax of negative rates. Third, Asia, China, so far no sign of coming out of the structural hole in which they are, with over massive investments in real estate. If you think about now, the most indebted company in the world, Evergrande, with 300 billion defaulted, and now they've discovered an $80 billion fraud in sales. It's something unheard of on such a scale. No investor are left on the public side really in China, and now has become basically a fashion to say you're not invested in China. So we think actually, because it's so important from an industrial point of view, today those that are left with assets in China, probably they should keep them. We in financials don't really like them because we can't trust most of the capital allocation decision. In Japan, historical decision, they decided to come out of the negative and zero band policy, and I think it's a path that basically will eventually strengthen the yen vis-a-vis 150 to the dollar, in particular given how much dollar the world is printing right now. Overall, I think financials over the next 2-3 years are going to be the key beneficiary. If you look at Europe in particular, dividend plus share buyback, the average sector will pay you 20% in the next 2 years, with some of the key champions up to 30%. So 30% cumulative returns between dividend and share buyback in the next 2 years. It's quite extraordinary. And we think it's going to continue. At the same time, overall in fixed income market, given that there's been a huge rally, in particular in investment grade and in anything that is government debt, we don't see much upside there, even in some of the high yield names, while financial credit keeps on offering fantastic value on an absolute yield, but most importantly in spread. So you can still get paid 6 to 7% in US dollar, which is quite unique for a 3-year risk, with the safest name in the world. Thank you.